exciting to see you all and to bring this element of professional development back. It's been a long I think two years, right, Clay?
Yeah, something
Uh,
like that.
yep, 2 years. Um, and we wanted to make sure that as we lead up to our University of Michigan football networking event, we want to engage our student athletes on the football team and others, and have several topics around different areas of industry. And so tonight we're going to talk about some elements of finance, and then we're going to introduce our special guests. You'll hear about their esteemed careers. What I tell you, it's very impressive. The virtual mentorship series will engage was created to engage our current football players in forums that will provide insights and resources to support the successful launch of their careers life after University of Michigan. These videos will be recorded and indexed so our student athletes on our football team and other teams can go back and view them later. Our hope is that they continue to inform, empower, and guide our football players into the next steps or next phases of their careers. Boy, I tell you, we got some esteemed guests here, some former Michigan players who have done amazing things. And so for the student athletes that are on now, pay attention. It's a lot, right? It's a lot. Ask tons of questions. But let me get into our first speaker here. You should all know him, Clay Miller. Clay Miller has been around Michigan athletics for a number of years in different areas. One area is he's responsible for or co-responsible for the football networking event we have every single year. And he's also with him and his beautiful bride allows us to go to Minneapolis every year. And then this year we're going to go to London. Clay Miller has over 30 years experience in private equity and legal experience, identifying investment opportunities successfully, investing in a broad range of industries and companies throughout the United States, internationally, managing and driving significant growth in such portfolio businesses and structuring, executing, and successfully exiting such investments through both public and private M&A and capital market transactions. Mr. Miller co-founded and currently co-manages several investment funds, including E2SG Partners, a fund focused on renewable energy infrastructure development projects, and Stone Arch Capital, a highly successful Minneapolis-based private equity firm focused on investing in private held middle market companies throughout the United States. Mr. Miller is a graduate of University of Michigan with his BA, Northwestern University School of Law, his JD and cum laude, and Harvard University with an MBA with honors. Mr. Miller is licensed to practice law in New York and is an adjunct professor at the University of Michigan Ross School of Business, where he teaches classes on private equity. So we have a treat tonight. We have a treat tonight. And let me get to our second, and I want them after this. I would love for them to say something before we get into this. Our next guest is Mr. Ken Higgins. We had the fortune of meeting Mr. Higgins at his company on one of our trips to Minnesota. Let me tell you, if you haven't been to Minnesota, you need to go. Ken Higgins is a managing director and co-founder of Northbourne Partners, a merging and acquisitions focused investment bank based in Minneapolis. Ken has over 30 years of M&A and advisory experience spanning M&A investment banking, venture capital, and transactional law. Prior to Northbourne, Ken led middle market M&A healthcare team at BMO Capital Markets. Ken received his JD from Harvard Law School and a BBA from the University of Michigan's Ross School of Business, where he was an academic All-American wide receiver for our University of Michigan football team. Again, I told you a treat. These gentlemen went beyond the field of play and gained success on the field of play, but they gained success in not only the classroom, but in the corporate world. So if we could take a couple minutes, Clay, if you can introduce yourself, say hello to everyone, and then Ken, do the same.
Well, thank you, Maurice. I'll jump in, and then Ken, you can follow up. Yeah, Ken and I had the good fortune of being teammates back in the old days. We both played in the '80s and enjoyed it very much. Since then, as Maurice had kind of highlighted, I've done a number of different things. Started out after 2 cups of coffee and a sandwich in the NFL. I ended up going to law school, which then took me to New York and London, and then that led me into private equity. And in order to kind of get in, I decided to go back and get an MBA. And I've been doing private equity now for 30 years. It's a fascinating field. When I got into private equity back in 1995, it was an emerging kind of asset class, very nascent. It was a lot of things still to be figured out. Roll the clock forward 30 years later, it is a defined asset class internationally. And I teach a class at Ross in kind of the fundamentals of private equity, but also a global private equity class. Private equity is here to stay as an asset class. And as I tell my students, even if you don't want to be in private equity, you'd better understand it because it will find you. And what I mean by that is I have 2 daughters who both attended Michigan. And in the last 24 months, both of their companies have been acquired by private equity-backed portfolio companies. So it's a wave that's here. It's different than the public M&A markets, but it's got a lot of similarities, a lot more hands-on, a lot more control, as we'll talk about later tonight. And I'll kind of leave it at that and then pass the ball all to Ken. I will say I enjoy questions, a lot more fun and a lot more interesting if it's iterative. So please don't let me wax on. We have a few slides here we can talk to, but jump in. Don't wait for the end to ask questions, and we'll do our best to see if we can answer them. With that, I'll turn this over to my good buddy Ken.
Thanks, Clay. And I'll just be quick. So similar to Clay, I actually went to law school out of undergrad after getting a degree from, what's now Ross, wasn't then, but up in the business school. And really as a way to get into the mergers and acquisitions world, which I thought would be interesting. Eventually moved over to the investment banking side. I've worked at a variety of firms, both large and small. And sort of the really wanted to talk a little bit about sort of what does it mean to be an investment banker today, and what do you do, and how does it work? But it's something that never gets dull. It never changes. We work with business owners when they're ready to sell their business, and that process is a process that's complicated and full of ups and downs, and always different, and something that I think is extremely engaging as a career.
Thank you, Clay and Ken. Now let's jump into it. Again, as
Okay.
I said, for our student athletes, if you have any questions, please put the questions in the chat, and they will love to answer your questions. All right, tonight we're going to talk about the fundamentals of private equity and the sale process considerations. Let's start with private equity.
All right, I'll let you drive the bus here, and I'll just kind of speak to it as we go through the slides, Maurice. So
Yes,
today
sir.
I'm going to quickly touch upon, what is private equity? Private equity is a very big word. It covers a lot of different, things from venture capital all the way to what I call large buyout. So today we're going to talk a little bit about that spectrum. We're going to talk about, what are the fundamentals, what makes a good investment in private equity and doesn't, and kind of what are the models, and then we'll kind of finish with quickly a brief discussion about the state of private equity, the private equity market. So next slide. So as I mentioned, private equity is really a spectrum. When you think of it from left to right, starting with venture capital on the far left and moving to large buyout on the far right, the key word here is private. As opposed to the capital market, the public capital markets, you think about the stock exchange, you think about the public bond markets. Private equity is by definition private. And that has a lot of different elements to it and a lot of different advantages that don't behoove themselves to the public capital markets. And that's where I want to draw the distinction. So when you think about venture capital, it's really about, something that is new and disruptive. To be successful in private equity, or excuse me, in venture capital, you need to have some kind of a disruptive technology. You have to have vision, and you have to have the ability to scale quickly. A lot of my friends that are in venture capital talk about white space and talk about how quickly They can gather market share and be a first mover. Those are the things that are critical in terms of venture capital. As you move along the spectrum, you come to what we call growth equity. And the difference between growth equity and venture capital is by the time it becomes growth equity, it really is a concept that's, if you will, the base case has been proven. It's a proven model that works. It's just a function of how quickly and how well, you can build the business. And to be successful in kind of a growth equity universe, you need to have a very, kind of detailed and capable operational expertise, and that requires management talent. Whereas a venture capital kind of investment is often about the idea and it's about raising capital so you can quickly kind of cover the ground. When you get to growth equity, it's about the nuts and bolts of running a good business and running it well and having management talent that can do that. And so that's kind of the next step. The next leap, I guess, is to buyout. And the difference between growth equity and buyout is really your ability to leverage the transaction. So when you get to buyout, you can actually borrow money against the company. It's no longer all about growth, and it's no longer about burn rates, and it's no longer about just organic opportunities. It's about the ability to bring debt to the table to finance your transaction and value the business accordingly. And so to be successful kind of in the buyout world, particularly on the lower end, which is where I've played in more of what I call the middle market, and people define that differently. Some people refer to that as less than a billion. I kind of lived in that less than 500 million universe. So we would buy companies that were often founded by families or a handful of partners, and we were the liquidity opportunity for them when they wanted to retire. They didn't have anybody to pass the business on to in their family or within the existing management team. So then you have large buyout, and large buyout is the stuff you read about in the Wall Street Journal. That's the mega billion-dollar deals. That's the Blackstones. That's the Ares. That's the people that are doing multi-billion-dollar transactions. And that's really very, very capital market intense. When you get to that level, everybody running those businesses is very capable, very trained, and very knowledgeable. You're not really going to be able to find opportunities to kind of buy something particularly cheap. Maybe you can from time to time, but more often than not, it's about finding companies that are underperforming, taking them private, and then retooling those businesses while they're private, and then typically taking them public again. And that's what the mega firms are all about. So where you play and how you play depends on what part of the spectrum that you're involved in. Again, venture capital is about kind of hyper growth, grabbing white space, having a great idea that's disruptive, and being able to see something that's new and different. The growth equity, now your base case and your beta case have been proven. Buyout is now your mature business that you can actually borrow money against and commercial lenders will lend. And then the large stuff is really for the big cash cows. You go think all the way back to the late 80s and talk about the RJR Nabisco deal. No reason why cigarettes and cookies and crackers ought to go together. It was just there to kind of, if you will, feather the nest of the management team. And that's why it's the classic example of a large buyout. Next slide. So what really are the pros and cons of the private equity model? We'll talk about the levers of the model in a minute. But the pros of a private deal are that it is a controlled transaction. It is an active investment group that is dictating the terms, setting the management team, and really kind of plotting the course, I guess, for lack of a better word, about where the company is going and how it gets there. Private equity, again, is almost by definition one about control. And so you have operational control. Every deal I've ever done in private equity, we own at least 51% of the company. So we can fire and hire CEOs. We can change out management. We can dictate the direction of the company. And we're not a 5 or 10% owner that is trying to persuade or otherwise influence. We can actually take control of the wheel if we don't like where the company is going. So the second component to it is operational control. The next piece is the ability to manage risk. And what I mean by that is, you can choose how much debt you put on a company. And, the more debt you put on the business, the higher the return, but the greater the risk. So you can manage ultimately how much debt you decide to put on a business when you acquire it, the rest being obviously equity. And that's your ability to manage risk in many ways. You can also, since you have operational control, make sure that management doesn't take bets with the company in ways that would put the company at greater operational risk, which is different than financial risk. But on both of those levers, you have the ability to kind of maintain that, and you have the ability to dictate where that goes. And so you have nobody to blame but yourself when that succeeds or fails. The next piece is what I call the ability to drive returns. And where you see that is through add-on acquisitions. and we can talk about that a little bit later in the presentation. But one of the ways that we really drive value at Stone Arch Capital is by buying competing businesses, putting them together, and having 1+1 = 3. And what I mean by that is you're getting leverage both in terms of synergies. You buy a company, you put the businesses together. Your salespeople suddenly have a bag with twice as many products in it to sell. You can have synergies within your operating plans. You can have synergies within your sales force. You can have synergies across the board. All of those areas are ways to drive returns. And if you're successful in making companies bigger, better, stronger, and faster, you can often sell them for a higher earnings multiple than you bought them for. And that's what we call multiple arbitrage. And we'll talk about that a little bit later, too, when we get into our lever. You have the ability to control liquidity. So what I mean by that is you can call your shot on exit. So when the stars line up and you've got the company operating well, your industry is doing well, and there's a large macro positive tailwind in the economy at large, that's the kind of time where you want to think about going public or taking the company out from market and hiring Ken to go help you sell it. Those are the kind of things that you can control, and those are the ability to call your shot. If the market's not good or the company's not performing at its top level, or if the industry is troubled, you don't sell. You hold that. And as a result, you can ride out some of those tough patches while you're still private. And then when you exit, you can line those up and hopefully maximize your returns. Because of all of the foregoing concepts, you can generate relatively consistent performance. Now, that's not a perfect science by any stretch of the imagination, but if you look over decades, private equity typically outperforms public equities by about 500 basis points. And the reason for that kind of premium is your ability to kind of generate this kind of growth, generate these returns, drive these returns with your control, and then exit accordingly. And that continues to deliver what we consider to be much more consistent performance. And then last but certainly not least, there's a tax preferred status. And by that, I mean there are certain provisions in the tax code that allow you to actually come off with a better after-tax return. Also, your ability to deduct interest from your taxes also helps you use leverage in a transaction and build your returns by putting less equity in and getting a higher multiple on your return. On the con side of the table, you've got all the risks that go inherent with any kind of an equity investment, public or private. You've got macro risks. You've got potentials for tariffs. You've got inflation. You've got different things the Fed may do, or you may have other economic kind of macroeconomic risks that can upset the apple cart. You have capital market risks. The capital markets can change quickly, and they can often change in adverse ways. You saw a couple of years ago where interest rates went up by almost 500 basis points in less than 6 months. That can significantly increase your cost of borrowing. It can also shut down capital markets in terms of your ability to borrow money or in the ability to kind of find an exit. Leverage does cut both ways. The more leverage you have on the company, the more what I would call vulnerable it is to these kind of macro events, which could upset the apple cart to the point where you could even bankrupt the business. And that has happened. People got too aggressive with leverage, and then they got caught sideways in a large macro downturn, and it flipped the boat over. You got management challenges. Management is inconsistent. There are, a lot of opportunities out there to find good managers, but sometimes you swing and a miss. And so sometimes you have to reset the clock and go back to the beginning. So management challenges are people issues like any business. Competition is always out there looking for you to stumble. You've got political risk. You may be, let's say right now, you're an importer of goods from China, and suddenly there's a 25% tariff against whatever you're bringing in. That can significantly impact your business in an adverse way. You could also be, involved in different type of industries that are either in favor or out of favor. 4 years ago, if you were in the oil business or the energy business from a hydrocarbon perspective, you were getting, kind of all sorts of shots. Now it looks like it's going to go the other way 4 years from now. Who knows? And then you also have the potential loss of some of this tax preferred status, whether that be capital gain or deductibility of interest. Those are things that are at the whim of Congress, and one never knows kind of where they'll go. But at the end of the day, the ability to execute effectively, all the items are on the left side of the ledger here on the pro side, and then manage effectively the cons will allow private equity to deliver the extraordinary results that the asset class has seen over the last 30 years. Keep going. Next slide. So the model of private equity really is very simple. A lot of things in life look complicated, but they really aren't. God knows if I can do it, anybody can. So, I mean, you've got fundamental levers here in terms of driving growth. So the first is to pay down debt. Fundamentally, you use debt by part of the business. If you say you bought a company for, $100 million and you put 40 million of debt on that business over the next 4 or 5 years, maybe you pay down 20 or 30 of that. But then you've got your equity that filled the gap. You want to grow cash flow. Then that's EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. So effectively, you're growing the cash flow and the earnings of the business. And if you can build a company that's bigger and better and stronger, but even just bigger sometimes gives it more stability, gives it more interest via larger buyers. And then you get what they call a multiple arbitrage. So say you're buying a company at 7 times cash flow, you can build it up, you pay down the debt, and then you sell it for 8 times cash flow or 9 times cash flow. That's what they call multiple arbitrage. And that really provides the juice and the rocket fuel if you want to see how you can generally achieve some extraordinary returns. So if you buy right, and by that I mean you're kind of buying at a multiple that is consistent with the market and you don't overpay, you can generate, and just pay down debt, which is lever number one, you can generate solid mid-teen returns. And if you buy right and you can execute levers 1 and 2, which means you can pay down debt and you grow cash flow, you can typically generate 20% returns. And if you buy right and you can do all three of these, then you can generate 25, 30% returns or even greater returns, depending upon how much leverage and how much or multiple arbitrage you're able to achieve on your exit. Next
Clay,
slide.
we got a question before we move to the next slide.
Yeah,
So Josh posts, he posts, with higher borrowing costs and tighter credit markets in the economy, how are PE firms adjusting their use of debt and overall investment strategies?
They're using less debt. It's just that simple. When the price goes up and the banks are providing you with, a less debt on the transaction, then you have to fill that hole with equity, or you fill that hole with some other type of hybrid security, like what they call an earnout, or you use seller paper, but you use other instruments that are kind of quasi debt, quasi equity instruments that allow you to get the transaction done. Sometimes there's also what they call mezzanine debt, and mezzanine means the middle, right? So it's more expensive debt. It's junior debt. It sits behind the senior debt. So think bank debt, but before the equity. And it's a fulcrum piece of capital that allows you to get your financing put together in such a way that it is more expensive than if it was just senior debt and equity, but less expensive than if you had to put more equity in. Remember, equity is your most expensive piece of capital. Any other questions?
The other reaction to that is in the market is buyers are trying to pay lower prices for business. So if you can't raise as much debt, that's more expensive. You don't want to put more equity in. The other way to solve that problem is pay a lower price. So
Right.
that puts pressure on valuations for sellers in the market too.
Yep. Well put.
So then I have a question. What the market is today and how things are shifting in the last 2 weeks, what would your advice be for small business owners or someone that, should they hold right now, with the market volatile or unstable or not knowing what's going to happen in 2 weeks? What would your suggestion be?
Go ahead, Ken.
Yeah, I mean the quick answer is it depends, but you have to be careful to not let the headlines guide your decision whether to sell the business, because it really gets more complicated. That your business may be in an industry that is really doing well. Like if you're a medical device company right now, there's a lot of appetite to buy medical device companies. Yeah. On the other hand, if you're a company that's a manufacturing business that's making a lot of products in China, the whole tariffs thing is probably, makes your business not saleable for the short term until that sort of cloud on the horizon clears. So so some of it's just, that's what we bring to the table as an investment bank, is some insight into those market conditions. We're constantly talking to buyers like Clay, private equity funds, strategic buyers. And so, it's just really a function of understanding, how that macro environment really is hitting your micro part of the business, or your industry, your particular size of business, et cetera.
Okay. There you go, Clay.
Ken will go into this in greater detail, but it takes probably 6 to 9 months to sell a business through a process from the time you start to the time you end. So, there's lots of broadsides that can come and surprise you while you're in that process. So again, to Ken's point, you got to try to read through the headlines and look at the company and look at the industry and say, okay, is this the right time to sell? And occasionally you get hit with one that's big enough that just forces you to hit pause. Like Ken talked about with if you're selling a distributor that's importing from China right now, any buyer is just gonna be so, if you will, careful that you just really can't go forward. So you just got to put that on pause. But if you're in other industries, you continue to move ahead. And there are ways to bridge the value gap too that we can talk about later.
Okay, thank you.
So, the challenge is to realizing that the values and the fundamentals that we talk about is making sure you buy right. Ultimately, buy right is somewhat of a subjective concept, but basically, you look at the market and you look at over the last 3 to 5 years, and you look at what companies are trading for, and you want to make sure you don't overpay, because excessive purchase price really kind of unwinds all three of those levers I talked about before. So if you pay too much, you reduce your multiple arbitrage opportunity, because effectively you've given that to the seller on the way in the door. You've paid more than you should have. You paid a higher cash flow multiple than you would have. And so your ability to kind of get multiple arbitrage on that number is inhibited. Excessive purchase price also typically includes more debt. And so logically, if you have additional debt, you'll have more interest expense. If you have more interest expense, you're not going to pay down as much principal. So you've unwound the first lever as well. So excessive purchase price also reduces liquidity. Most of your money is being used to basically service the debt, whether it be interest or whether it be principal. So it also inhibits your operational flexibility. So instead of having cash to hire new salespeople, instead of having cash to put in new machines in your plant, instead of having cash to buy another company to expand your product line or your market footprint, you've got to service the debt. So you're inhibited on that front as well. And then last but certainly not least, it talks about reducing your ability to drive organic growth and your acquisitions. So it just consumes your balance sheet capacity. So buying right is important, and it's probably the single greatest challenge to realizing kind of the advantages of private equity. So when you think about this, growing EBITDA is really, really hard. People talk about, oh, we'll just grow cash flow. Well, everybody else there competing with you is trying to do exactly the same thing. So growing EBITDA is hard, and that's probably the single greatest challenge in the private equity world is actually what do you do with the elephant once you own it? You got to make the elephant dance, as I like to say. So you buy this company and you've really got to work with it, in order to make it a bigger, stronger, faster business than when you came in. And the good private equity firms are the ones that are able to really do this consistently. It's not about financial engineering. It's not about just levering the company up and hoping it pays down its debt. It's really, you got to make it a better business before you sell it if you really want to maximize the returns for your investors. So, competition's a limiting factor. Management talent's not a given. Cost reduction opportunities and, balance sheet improvements are often much more difficult to realize than they look like on paper when you start. And then you've always got the macro surprises, which are, exchange rates and tariffs and geopolitical conflicts. They all get in the way and they all make a challenge out of what you're trying to achieve. Also, capital markets and financing options are variable and inconsistent, as Ken talked about. Things can move quickly. Interest rates can change quickly against you or in favor of you. You never know which way it's going to go, and you have no control over that. Lenders can also turn very conservative or aggressive based on a number of these influences. Things get ugly, the banks just stop lending. And when they stop lending, prices come down. So you're forced to hold it for a much longer period. So, poor lending or capital market environments can significantly hinder your acquisition opportunities and extend your hold periods. And by extending your hold periods, then you're typically going to drive your IRR down. So your return on your investment is going to go down as a percentage the longer you hold it. Now, the ironic part about private equity is that even while you're holding it, if you have to hold it longer, you're still paying down debt. So actually, it's not a sum-zero game. Now, if you're in venture capital, you're not paying down debt, you're just slowed and it's longer. It's a much more draconian impact if you have to hold the investment longer than you want. And then liquidity can drive quickly, which is what we talked about before in terms of prices come down, you're forced to hold, and that can go on for years sometimes. kind of turning the page here quickly, when you're out there looking for a private equity investment, there are a handful of criteria that we always look at that are really important when you're looking for the right company to try to invest in. The first is a strong management team. I would take a strong management team in a mediocre market over a weak management team in a strong market. You'll find that what you really need is you need a team that can weather the storm. Fair weather captains don't help you at all. You want stable performance. Remember, you're putting debt on a business, and so banks like stability. They do not like surprises, and so stable performance will allow you to put more leverage on a business. Strong free cash flow is also important. You want to see your cash flow pay down debt or be able to use it for growth, whether acquisition or otherwise. You don't want a company that makes 10 million of cash flow and spends 8 million a year on equipment to continue to make 10 million, because net, it just doesn't throw up much in the way of profit. You want to have organic growth, at least at a moderate level, and you want to have the ability to drive that growth by some fundamental, whatever you decide to do. Add to the customer base, add to the product offering, add to the geography. A lot of ways to grow that business. You want to have the ability to see that in a number of different ways. You want to have solid profit margins. And this is an important point that I think people often miss. I always refer to it as if you were flying in an airplane at 40,000 feet and you hit an air pocket and the plane suddenly descended 10,000 feet in the next 30 seconds, you're shaken, but you're still flying. If you're flying at 5,000 feet and you hit that same air pocket, you're toast. So, if you have profit margins of some stature, you're able to withstand a lot of surprises in the market. If you have a very thin profit margin, then you're likely to be very vulnerable to those kind of broadsides. You want healthy industry dynamics. You look at a lot of industries that are very difficult because the value chain analysis is such that there's a part of the value chain that ultimately dictates where the value gets taken out. Automotive is famous for that. There's thousands and thousands of automotive suppliers, and they all just get beaten about the head and the shoulders by the big three or the other larger car manufacturers. Being a vendor in the automotive market is a very hard neighborhood to live in. You want to have a competitive strength, or what people would call a moat. You want to have some kind of proprietary product or service offering, and even if it's just you do it better than everybody, you want to have something that's a defendable market position. And then obviously, a fragmented market means there's a lot of different opportunities out there to do acquisitions. And those are the kind of ways that you can take big bites in terms of growing the company quickly and finding those synergies that allow you to get multiple arbitrage on the exit. And then last but not least, we always talk about not really wanting to get into a deal unless we have at least some good idea about how we're going to get out. We're not permanent owners, unlike a family that may own it for generations. Private equity is in the game for 4 to 7 years. And we're on the clock from the minute we make the investment, and our investors expect us to turn it and turn it at a profit in about a 4 to 7 year horizon. And so those are the kind of things, the more buyers out there, the better off you are, and the more capable you are to hire a guy like Ken who can run a competitive auction to make sure you get the most value for the business. And those are the fundamentals of kind of private equity. This is somewhat of a Reader's Digest version, but these are the key concepts that I've lived with for the last 30 years. And if you're interested in private equity, these are things you're going to have to internalize and know well. So with that, I'll leave it for questions and then turn it over to Ken.
Questions? Thank you, Clay. Every time I hear some of it, I learn. Every time you say something. All right, so Ken, we're going to talk about bring King on for sale process considerations. I'll turn it over to Ken.
Great, thanks. So I want to hit a couple of key topics in a sale process, but maybe start by saying, I get the question all the time, what do you do as an M&A advisor? And it's sometimes hard to explain. It's as simple as what Clay sort of described, is that we effectively are running a controlled private auction to find the best buyer for a business at the highest price. But to do that, and the reason why it's sort of interesting, I think, is it requires a bunch of different skill sets. I mean, you have to, first and foremost, you're a trusted advisor to the client. You have to give them good advice on key decisions during the process, key decision on terms, buyers, when to sell, et cetera. And that's a big part of the equation. And then you have to be an expert in the client's industry. You have to know how to describe their business and its opportunities to buyers. You have to be a great marketer to tell that story. You have to know who the buyers are and how to get to them, and so you can get multiple buyers to compete for the opportunity to buy the business. And then you have to be a great negotiator, because ultimately you're going to try and negotiate the best terms you can on behalf of the client. And meanwhile, you have Clay on the other side of the table trying to negotiate the best terms as a buyer. So that's the inherent conflict. Now, a sale process typically has a catalyst that gets it going. So I've hit some of the reasons here how a sale process is initiated. Sometimes there's inbound interest. There may be a strategic buyer or a private equity fund that really wants to acquire a business like yours, and is reaching out and trying to sort of get in the door to start that conversation. That often could trigger a business owner's interest in saying, hey, maybe I should sell the business. A recent comparable sale is often a trigger. One of your competitors or a similar business gets sold at a very high valuation, and often that catches the attention of an owner and says, hey, if they can sell their business for that, I would love that, and I might as well go do it. And then from a private equity owner's perspective, their hold period makes a difference where they are. Clay mentioned they're typically shooting for 4 to 7 years as a holding period. So if somebody puts an offer on the table 2 years in, that may not be that interesting. If you're 8 years in, you may be a lot more willing to entertain offers, because you want to get that business out of the portfolio. Now, the flip side is if the business has really performed, somebody that wants to acquire it for a high price in 2 years, that's great, because then you're delivering a higher annual return to your investors. So often, if you have a business that's a rocket ship right out of the gate, that business may get sold sooner rather than later by a private equity fund. And then the other one is sort of the industry's sort of secret they don't like to talk about. Often what drives a sale process is your fundraising objective. So you're investing a $400 million fund, you've got 10 investments in the fund, and you're fully invested. Well, you want to go raise the next fund so you can continue to grow the business. And so to do that, you need realized returns. So that may drive a sale process. So you can post a realized return, so investors can look at it and say, hey, they made 4 times their money on that deal, 3 times on this one. So I'm willing to put money into their next fund because I think they'll continue to have that success. Next slide. So timing of a sale, we talked about some of the triggers. If you sort of dig into that a little bit, on the private equity side, as an owner, you're sort of, measuring both your annual return, your IRR, and your multiple on invested capital. So, a 30% IRR is great. If you did that in 1 year, you're only 1.3 times your money, and that's not great. It's okay, but if you do that over 5 years, you're probably close to 3 times your money. So that's the balancing act that a lot of private equity sellers will play in terms of what do I want to post? Do I want to do the quick positive IRR? Do I want to play for a big return on my money as a multiple? And then we talked about anticipated next fundraise. On the company side, there's a lot of complicated questions. From the management team's perspective, are they going to stick around for the next owner? So when you sell the business, are they willing to re-up and commit to another 4 or 5 years of running the business? Obviously, the more likely they are to do that, the better. What kind of visibility do you have on business performance? It's a 6 to 9 month process to sell a business, sometimes longer. And so what you don't want to do is miss your numbers or miss your forecast during the process, because that can really have an outsized impact on the result. And then on the upside is, are there key milestones or opportunities in the next 6-9 months that would really create value? Do you have a huge new contract that you expect to win, that if that happens during the process would be a huge positive? So all that stuff goes into the thinking of is now the right time to sell. And then on the buyer side, if you put your buyer hat on, you've got all the other things. What's the market like? What's the lending environment like? Do I feel like the economy's going to do okay, or will there be a recession? Is your business particularly vulnerable to a recession? How strategic is the business for me? Do I know the industry? Do I have a company I can put it together with? So 1 + 1 = 3, because there's positive growth synergies. Yes, there's just a whole bunch of things that go into that what's the best time to sell, and because once you launch a sale process, it's hard to pull it back, and so what you don't want to do is launch at the wrong time, and ultimately it's a judgment call. Next slide. I mentioned that one of the skill sets of a banker is you have to know who the right buyers are. And there's really sort of three buckets of buyers in general. One is the pure strategic buyers. So think of large companies, public companies, the like. They are often very acquisitive. In theory, their cost of capital is much lower than private equity buyers, so they should be able to pay a higher price because they don't need as high a return to make the deal work. And so, you certainly, and they understand the business and the industry. So there's less education of the buyer, when you're marketing the business. Now, on the flip side, they tend to move slower. They can be very political. And so they're sometimes hard to push through a efficient sale process compared to private equity. On the other extreme to the right, far right, is private equity. And, Clay walked through sort of that. They're looking for great businesses to back great management teams. They're going to utilize leverage for the deal. And so if you're a seller that has a great management team, you might be a good candidate. If you have a management team that has a bunch of holes in it or is incomplete, you might not be, because that's a lot of investment the private equity fund has to make post deal, and there's risk attached to that. In the middle are sort of probably the most active segment of the market are the private equity backed strategic buyers. And here you sort of get a little bit of the best of both worlds. You have an existing business that's owned by private equity, and they're trying to grow it through value added acquisitions. And they often, it's a very common part of the playbook. They have very active outreach efforts to identify businesses to acquire. They can move quickly, but they still understand the market, and they can still realize some of the strategic synergies that a strategic buyer can achieve. So that can be a very attractive buyer. The downside is if Clay's in year 6 of his hold period, he's probably not going to make a big investment to acquire an add-on acquisition because he doesn't have enough time for that to grow and realize incremental value. So you sort of have to understand where those companies are in their life cycle in terms of ownership. You flip to the next page. So here, I want to spend a little more time on this slide because this is sort of M&A 101, if you will, and what we do. Is sort of what kind of process do you run? And we talk about it being sort of a controlled private auction. And what that really means is we want to help a company get ready to sell itself, which means get organized, pull together a data room, clean up your financials, do a whole bunch of things so you can show well in a sale process. And then we want to bring as many buyers to the table as we can at the same time, so they're forced to compete, because nobody puts their best price on the table unless they have to. And the way to force them to have to do that is to feel like at some point they've done the work, they really like the business, they want to acquire it, and they don't want to lose it. So tell me what I have to pay so I don't lose it, because I don't want to, I spend a bunch of money, time, effort, and I don't want to miss the opportunity. So that's sort of at a high level what we're trying to create. And that can mean a lot of different things depending on the situation. And, some of our clients are privately held, owned by a founder, and that founder may be tired, I'm ready to retire, and I want to hand it off to somebody else. Well, that means, hey, I probably want to find the best cash buyer, because I don't want to, I want to just cash out. I want somebody that's willing to let me transition out over a short period of time after closing. On the flip side, there may be a younger, CEO, owner that really wants to keep growing the business, but he needs capital to do it. And there, private equity might be a much better solution because you're allowed to reinvest in the business. So if I sell my business for $100 million, I'll roll over some of my existing value into that new business, and maybe I'll own 30 million of equity. And if things go well, that 30 million of equity could be worth more than the 100 million you started with. So situationally, it can be very different, and that'll dictate a little bit in terms of which buyers you go to. But at the end of the day, our bias as bankers is go to more rather than less buyers, because we do the work to contact them. If they say no, that's okay. And we typically, when we go out, we may go out to anywhere from, we'll go out to as few as 3 or 4, but as many as 400 buyers in a process. And the more you go out to, the take rate on even just looking at the materials and understanding the business, maybe 50% a really good deal. So you go into 300 buyers, 150 just said nah, not even interested. 150 decided to review the details, and then your bid rate, you may get 20 bids. So you went to 300 parties, you only got 20 bids. That sounds like, gee, you got no, you heard no a lot. But that's actually pretty good, because then you have 20 bidders at the table that you ultimately can hopefully get to compete and narrow down to a smaller group that's going to pay the highest price. And the market is super inefficient in private M&A. So unlike public company transactions where you have a stock price that values the company every day, every minute during the trading session, private companies, there's none of that. And you have some data on comparable companies, that what they've sold for, but nothing's really truly that comparable when you really peel back the onion. And so one of the reasons to go broader too is because you get very different valuation feedback from buyers. And there's sort of a rule of thumb in our business that the low bid in the first round of bidding is always less than half of the high bid. And so they looked at the same materials, the same company, the same thing, and one party bids 30 million, the other one bids 80. So it's amazing how that rule of thumb, holds true. I have one recent deal where the low bid was 25% of the high bid. And you're sort of wondering why the low bidder even, wasted the time to bid. But our goal then is to take sort of after that initial bid, is take the highest bidders, the ones that are the best fit, most equipped to buy the business, and take them further into the process, have them do more due diligence, spend money reviewing the financials, spend money with their lawyers, and get to the point where there's usually a second round bid that's more developed. And as a seller, we want to keep people at the table for as long as possible. So we don't want to choose a party too early, because once we choose a party, that party starts to have more leverage on terms. So if they find something they don't like about the business, they have leverage to renegotiate purchase price, because our choice would be either to walk away or go back to another buyer, which is always tricky. So what we're trying to do is keep people engaged, involved as long as possible, and reduce the risk that once we do pick a buyer, that the closing of the deal doesn't happen. So that's the tension. Now the tension on the buyer side, I'm sure Clay would tell you, well, I'd like to go so far and meet the team and do my work, but I don't want to spend $1 million on transaction costs unless I feel like I'm going to be the chosen buyer. So that's the tension and the push and pull. And so we're trying to push them to spend money and do as much as possible, and they're trying to get early exclusivity to buy the company. And so as that sort of funnel goes down on the upper right, that's sort of what's happening. We reach out to buyers. We get indications of interest after we've given them what's called a confidential information presentation, which is really a document that describes the business and its opportunities and gives people a fair amount of financial information. If they have a good bid, we'll bring them in to meet management, open a data room, really dig into the details, start spending money with their advisors. And then at that point, at some point, you got to pick a buyer and sort of race towards closing. And as a seller, speed is your friend, because the faster you move, the less an unknown thing can happen to derail the deal. It's sort of Murphy's Law of M&A, is that the longer the deal stretches out, the more likely something bad is going to happen. You're going to miss your numbers. A customer's going to cancel a contract. Something, a tariff will be implemented that impacts your business. It's just, it's one thing after another. So my biggest worry as a sell side advisor is how do I get my client to move faster? Because they every day that happens is another day that things can blow up. So you have to be a little bit paranoid as a seller as well, and really push a process. And that's sort of what we do. It's not that complicated. We run an auction. We try and get people to stretch and pay their highest price. And sometimes it's highest price, sometimes it's best fit as well. Because if somebody's going to reinvest along with the buyer, like Clay's fund, you want to make sure you're compatible and you think Clay's going to add value going forward as the private equity owner and help your rolled over investment, grow in value. So there's other considerations. A lot of business owners are worried about what happens with their employees. Where we play, we're similar to Clay. We're playing in sort of the sub $500 million market for company value, and in that market, you win by growing the business. So it's rare that people don't come in and start cutting heads. It's more about how do they invest and help the company grow. So you want somebody, a partner that's going to do that and do that effectively. So all that stuff comes into play. I will say though, at the end of the day, our clients are driven by valuation, and so if you're going to choose the lower valuation, it's usually because it's very, very close, in a process.
Wow. So I know I had a question. So I think Clay, you said 5 to 7 years.
4 to 7, it could be, yeah, but it can be longer and it can be shorter. I think in the course of my career, the shortest I've ever held a company is about 15 months. And it wasn't really by design. We bought in and the company took off. And about 12 months later, a strategic knocked on the door and said, I want this company. And we said, it's not really for sale. And they said, how about this? And we went, let me get back to you. And of course, we huddled up quickly, and then we came back with a small ask for a little bit more and closed 90 days later. So that's the one extreme. Other companies I've owned for 12 years. And it's not because we wanted to, but just twice when we were looking to sell the business, suddenly the market fell out underneath us. Then you had to hold it. And so before you know it, you've been in it for a decade. I mean, it's just those things can happen. And so that's kind of the spread as it relates to ownership.
How many companies do you hold at any given time?
Well, the fund would typically call it 8 companies in a fund. It depends on the size of the fund. It depends on the size of the partnership. I mean, it's kind of like the military, Maurice, there's a span of control. And so, depending upon how many partners there are, 3 or 4 portfolio companies for each partner is a full plate. And if you've got 3 or 4 companies you're responsible for, it's much more difficult to be out there looking to buy another one. In other words, so it kind of turns over in that kind of a universe. So if you have 3 partners, then maybe you'll do 10 or 12. If you have 2 kind of senior partners, you might do 8. If you've got 10 partners, then you could have a big fund, and maybe you've got 30 companies in the portfolio. It just depends on the size of the fund and the partnership.
Okay. All right, so we're going to ask a couple questions, and it can go to either one of you. May not go through all of these, but we've seen all the work that you have done. Thank you for giving us a high level view, because I'm sure it could be in depth. You said it sounds easy, or it's easy, but it's not, right? And so it takes a lot of years. You two have a lot of years invested in this. But how did you get started in your industry, and what was your career path like? So again, financial services, as we talked about, it could be many different things. What was the driving factor that you said, I want to do this? Because there's many other things you could have done. Both of you have law degrees at JD. So, but why private equity and why the sales process?
But you go ahead, Ken.
Sure. The short answer is when I left Ross, the decision was, should I go the investment banking route and be an analyst and work 1,000 hours a week, or is a better way to get into M&A, go through the legal route? And that just sort of spoke to me. So I went the legal route. It was a time in the late 80s when the M&A market was booming, so it seemed like a fun place to be. I grew up in a family of doctors, so I had no clue what that meant, but that was sort of the way in. I joined a firm in Chicago where we basically did nothing but represent private equity funds buying and selling businesses. So it was a great way to learn. And as I did that, you meet people, you think about what part of the business do you like? And I liked the investment banking side a little bit more. It looked like more fun. I met some people and ultimately sort of moved over to that after about 5 years of practicing law. And I like to say, like, I joined as a generalist, and day two I was a healthcare expert. So I've been doing healthcare deals for 30 years. So and in a variety of contexts. And so it's just sort of one of those things you know I had an interest and I pursued it, and then you sort of try and do the best job you can. You make contacts and you sort of look out for opportunities that sound like interesting paths forward.
I was similar to Ken, except Ken's way more planful and focused than I was. I thought I was going to play in the league for a decade. That didn't happen. So I kind of ended up in law school by default. My father was a law professor, and he insisted I have a plan B. Well, guess what? Law school was plan B. And so I ended up going to law school and kind of found my way into a couple of classes that were talking about M&A and transactions, and that really appealed to me, and ended up taking a job with a large Wall Street law firm, that did M&A. I was in their M&A group, but I never saw the inside of a courtroom. It was all transactional work, and I spent a couple of years in New York. And one of the first deals that I got put on was divestiture work on the back end of the RJR Nabisco deal, and I started this thing called private equity. It intrigued me, and the more I worked, the more work I got involved with. It was some of the nascent players in private equity, and I thought, well, that after and I'm as a lawyer working for one of those firms like Ken was, you're putting in 80 hours a week. I mean, it's a grind, and it got to the point where I'm like, okay, I'd rather be a client than have one, and so that's what kind of got me to pivot and go back to business school to kind of find my way into private equity, because there weren't a lot of jobs in private equity back in 1993 or 94. So I ended up going back. I applied to various schools, got in, and decided to go to HBS, and that opened the door for people that actually came and recruited me out of school to get into private equity, and that's how I got there. And then once I got to private equity, it was figuring out the right firm and the right situations. And private equity and Ken can talk about investment banking too, but there's a number of egos in private equity, and you got to find the right culture, the right situation. And I went through two places before I founded my own. And the first place was a guy who was brilliant, but also very much a control freak, I guess is the best way to describe it. And that rubbed me raw. So I left and came to Minneapolis, and I worked for a firm that was completely the opposite, other than the fact, though, that the guys at the top weren't going to share. And so after making them quite a bit of money over about 5 years, I said, well, I can do this. And so I bet I could. And so that's when we started Stone Arch. And that's, spin the clock 20 years later, that's where that goes. So, it's not, I wasn't if I was 22, I didn't have a plan. It was kind of figuring out as I went from one hilltop to the next hilltop to the next hilltop. And before you know it, you're 60 years old. So it just that's how it played itself out. I don't know, Ken, if you want to finish on that.
Yeah, I mean, you sort of ask yourself, I grew up in West Michigan. Did I ever think I was going to go to law school and work in Minnesota for 30 years and be in healthcare? No, I mean, you can't predict that. So I think a lot of it is similar to what Kate or Clay described. It's just sort of, where does the journey take you? Recognize opportunities, figure out what you want to do, and then just go seize it, when they present themselves.
So what is, we're going to have a lot of, again, our student athletes, our football team watching this, paying attention and asking this question. What is one thing that you wish someone would have told you before going into this field? Or we can change it up a little bit. What is one thing that you wish someone would have said to you that would have inspired you to maybe plan, right? Do more planning and, and preparing.
Go first, Ken?
Why don't you tackle that one, Clay? I need to think on that one a little bit.
The one thing, I guess, that nothing is easy. I'll put it that way. People think if you're in private equity that you show up at board meetings and you go to dinners and you run around with if you will the masters of the universe. Not the case. I mean, the private equity universe that I live in is pretty gritty. I mean, I'm doing deals in Williston, North Dakota, and I'm doing deals in Lafayette, Louisiana, and I'm doing deals. These are not. I'm not staying at the Four Seasons in Chicago or New York. That is not the private equity universe that I lived in. And it's tough. I mean, there are times when you've got other people's money that have been, willing to back you with, whether they're institutions or individuals, and you put that money to work, and then everything's going wrong, right? You lived through 2008, 2009. You lived through. I will go further back. You lived through 98. When the dot-com crash. You lived through 2001 after 9/11. You lived through 2008 and 9 when the Great Recession was. We were teetering on the edge, and the entire portfolio could get washed out. Then just when you think you're like, well, maybe I'll get out of my career without one more problem, you get a pandemic. And so, wearing the portfolio can be very, very stressful. And so it's a lot of work when you own it because you go to bed with it every night and you wake up with it every morning. So, that's part of the job that I think that I didn't fully appreciate on the way in. You just have to kind of be able to compartmentalize your head and say, all right, I've invested in good people. I've invested in good companies. We will survive this tidal wave, and then we'll be good. We're good to go on the backside. But what that does lead you to as well is that private equity is a career of deferred gratification. You put in a lot of work and a lot of time before you get a dime a carry. I mean, our first fund at Stone Arch, we started in 2004, and my first dollar of carry, which is where the money is, was 2012. So it was an 8-year run. Now, once you get them going and they start to stack, it tends to happen more frequently. But the first go round is a long piece of deferred gratification. I'll just tell you that much. So anyway, I don't know, Ken, if you want to.
Yeah, I mean, the only thing I would add, I say this a lot, is that you have to sort of learn how to deal effectively with situations where you have a lot less information than you really want to have. And by that, I mean, you go through school, you study, you learn the material, you have it down, you get an A. You do that in law school. As a lawyer, it's sort of like that. You're paid to be an expert in a narrow field, and you sort of feel pretty comfortable about that. Once you get into whether you're on the buy side like Clay, private equity, or the sell side like me, it's complicated, and you never have enough information to feel fully comfortable with navigating a strategy, making a decision, and that's what you really have to get comfortable with, and you sort of learn that by doing it. But that's one thing that as I look back on it, would have been helpful to have more direct acknowledgement of that with coworkers and people above you that have more experience, because it's uncomfortable to having to advise somebody make decisions when you don't feel like you have enough information, but that's also part of the fun.
Right.
Once you realize what it's like.
Yeah, I would say one other thing, Maurice, is that the best and the worst of my whole career are the people. I've worked with some of the most incredibly wonderful people, and it's really gratifying when you have a deal and it succeeds, and there's a dozen people in the company that have a life-changing event, meaning suddenly they get a check as part of their incentive plan that allows them to pay off their house and put their kids through college. I mean, those are the kind of things that when you walk away, you feel like, wow, I'm adding value. It's not just about our investors or myself, but it's about all these other people that go to work every day, put in the time, put in the effort, and they execute the plan, and they get a piece of the pie. We always say we never want to own 100% of anything, and that's because you understand it's a team sport. Private equity truly is a team sport where you've got to you succeed because of the work that everybody does. It's not one person, and anybody who tells you it is lying, or they got an ego bigger than Dallas. So it's just, that's the fun part. Now the flip side is that I've worked with some characters over the years, and I won't name names, but there's been some people that they got all caught up in the disease of me. And that was a challenge. Those are the rough spots in your career are the ones where you have to run into those kind of people. But generally speaking, the people that I've worked with have been just probably the most gratifying part of the whole process.
Good. Essence of time, we're past our hour, but I want to give our student athletes, before we move on real quick, give our student athletes opportunity to ask some questions.
Sure.
You can unmute and just ask. You don't have to put it in the chat.
Yeah, I got a question. So I'm taking Finance 101 over at Ross, and we're learning about IRR and NPV, and the differences of that certain companies use different at different times. Are you guys using IRR and NPV in your companies? And do you prefer one to the other when analyzing a project?
Yeah, I mean, the short answer is yeah, that's sort of the price of poker. I mean, we're you know, we do the full range of fundamental valuation techniques. So some of that is NPV. I think of that as a discounted cash flow. So what are the future cash flows of the business worth today on a net present value? We do that every deal. We look at sort of IRR. What would a buyer's return look like if they paid between X and Y for the business? So absolutely, we do all that. That sort of stuff you have to master. The good news is it's not any more complicated than single variable algebra. So it's you get really good at it over time. But yeah, we look at all that, and it's the one thing I would sort of say is, it's never determinative. It gives you some insight, and but it's all driven by the assumptions, right? What's your required return, your discount rate, what's your exit multiple, so you can make sort of those analysis say whatever you want them to say. So the key is sort of taking those and applying it to the facts of the situation. Why would somebody pay more for a business in this industry versus another industry, that sort of thing. But yeah, no, for sure. So I don't. The answer is, do we prefer one or the other? No, we use them all.
Mm-hmm.
Yeah, I would go even further and say, we're really focused on LBO models. I mean, you can sit there and, get creative with your WACC and try to figure out what your weighted average cost of capital is. And you can go down to esoteria and debt betas, but none of that really, I mean, the assumptions that Ken referred to, and I'm talking about like revenue growth, percentages or margins or how you leverage the business. Those are all things that have a lot more impact than whether your cost of capital was 11% or 12%. And so we look at it. Remember too that, when you're using a discounted cash flow model, it's static, whereas an LBO model is dynamic. And so that's why when we look at models, we typically, model out, because it matters to us, how you finance the business. It's not just a pure, raw valuation in terms of how you think about it.
Thank you.
Good question. More questions? Okay. So I think, Clay, this is a couple years ago. It might have been you. I'm gonna give you if not, I'm gonna give you the credit anyway. In one of our last webinars, words to live by. I know this looks familiar.
Yeah.
And I think it's poignant because it's so true. All of our athletes in every area. Always pay attention to the small details in your life. You work really, really hard at being a professional in your sport, but if you don't pay attention, you become an amateur in life, right? And so you want to make sure you are a professional in every area of your life. Understand the value of the Michigan network. There's nothing more powerful than network. I read and I often tell the students that 85% of what happens today happens through networking. And reflect on your experiences and learn to translate them into stories that people outside of football and the world can understand. We often tell our student athletes, football is what you do, is not who you are, right? So as you continue to grow your knowledge, you grow yourself, and have a compelling story, something that people would want to hear. And then one of the greatest similarities between football and business is the importance of teamwork. I think I just heard that Clay said that. It takes a team effort to do that. You all have those attributes that most or every company wants, things that you can't teach. And the greatest thing that you have is how to work as a team. And everybody has a role within that team. And so I guess, for you all, as you're growing and developing, I would argue that find out what your role is, and be the best in the role that in your whatever that responsibility is. So if there's not any last, I'm gonna give you the contact information of our special guest. Please take this down, and if you don't have it, I'll make sure you get it. Again, I want to thank you again, Clay. And Ken, man, for coming in. It's 7 o'clock at night. Well, it's 8, but 7 o'clock on your time, right? In
Yeah.
Minnesota.
Yeah.
But you know, we know you work all day, right? And you guys are taking the time to help kick this off and spend time with us here. Believe me, the webinars that we did in the past, I still have students now and who are graduated who are making comments on those webinars. Because
I'd say
those,
one more thing as we leave today for you guys is that, you know, one of the things you're going to learn as a Michigan athlete, whether it's football or otherwise, is how to work hard. And there are a lot of people in the world when things get hard, they stop or they quit or they blame. One of the things you've learned, and Ken and I learned, kind of in the fulcrum or the furnace, I guess, of playing ball at Michigan was that you don't quit when it gets hard. You persevere. And so that's one of the things that you guys will have when you graduate that most people don't have. They just don't have that extra gear. They don't have that perseverance, and don't ever forget that. I think that's probably one of the reasons that I think I've been at least modestly successful is when things got hard, you just keep on going and have confidence in what you're doing and how you're going to succeed eventually. And by gosh, if it doesn't happen. So that's I would leave you with that. Can I leave you with anything else you want to say?
Yeah, no, I mean, I couldn't agree with that more. And I think the other thing I tell my children this, say yes, I can instead of no, I can't. And, if you're willing to take tasks on, that puts you, it really differentiates you and also gives you the opportunity to get in there and really build skills, build relationships and sort of move up the ladder, if you will. So it seems simple, but, you know, when you're working 80 hours a week or you're having a bad month, I mean, it's sometimes hard to remember that, but that's it's pretty simple. If you do that, you'll end up being successful.
I want to thank you both for that. Great words of wisdom. Look forward to next month's webinar. I'm sure we'll have a great topic and pass on to your teammates. And this is where they want to be for an hour, 30 minutes to an hour. No better time than to sit with someone who understands what you're going through, where you are as a current Michigan football player, who's very successful, but they can help you with some breadcrumbs in order to get where they are in life. So again, thanks Ken and Clay, and I look forward to connecting with you all in the coming days.
We'll talk